Hey guys, welcome to this week's video where we talk about running a fluid investment condo portfolio. You do not want to miss out because we want to tell you why you need to maximize your portfolio, always review and continue to grow it. See you soon. Hey guys, welcome to this week's chat. Alex Wilson, team lead of alexjwilson.com, and of course we have Kyle Dovigi, director of operations for Remax Wealth Builders Real Estate. So Kyle, I think we made reference last week's video, but what are we going to talk about today?
We're going to talk about the fluidity of managing a real estate portfolio and essentially what happens after you get 3, 4, maybe 5 units and how you need to start to manage those.
Yeah, or 11.
Or 11 in your case.
So, and why I say 11, because I get the question whenever I do a seminar, people go like, Alex, when are you going to stop buying? When's enough? Now, I live and breathe this industry. So I see opportunities all the time. I saw an opportunity today. There's always opportunities that come across my desk. And what I tell to people, I can be more risky in my portfolio management because I live and breathe this every day. And you have to treat your portfolio as a fluid portfolio. And that's what we're going to talk about today and what I mean by a fluid portfolio. So when I'm buying these properties, started in 2012, purchased the first one, and I continue to get more properties every year as I continue to buy in pre-construction projects. Kyle and I discuss why we buy in pre-construction projects. Now these pre-construction projects close every year. When I bought in 2012, things were very, very different. Lots of mortgage changes that have happened. We've had changes to amortization periods. We've had the stress test that has come up, obviously, what people are dealing with today. Interest rates change. I don't have a crystal ball and I don't know what's going to happen in the future, but I still buy condos because of the fundamental strength, I believe, in the Toronto market over the short, medium, and long term, as well as the passive nature of condo investments. So what gives me the confidence to continue buying these properties, knowing that I will eventually have to finance these in the future and get some sort of mortgage to solidify these properties? Kyle, does that keep you up at night wondering how you're going to get mortgages for your investment condos?
Yeah, it can start to be very stressful.
Yeah, and I tell people mortgage stress is the greatest stress out there.
It's the worst kind of stress.
It is stress.
You don't know if you're going to close a deal or what's going to happen, where the money's going to come
So it's
from.
very, very stressful. So when we talk about fluidity of a portfolio, when a project is coming closer to nearing completion, you'll know when it's nearing completion. There'll be delays and everything like that. But a year out, you'll have a good idea, okay, am I getting my condo this year? And at that year out moment, you're going to start doing your due diligence and figuring out, okay, what do I need to do to secure the mortgage on the condo? So first of all, you're going to go to your top tier A lending bank, one of your big 5, 6 banks out there to go get your mortgage, which will be easy in, I would say, your first 5, maybe 6 condos. After that, things are going to start getting a little more difficult.
And this is because of the rules that the banks have themselves, right?
So, yeah, exactly. Different banks have different rules, and different banks will put different customers in different buckets. So it's very important to know the different regulations that different banks have. Actually, I'm this is not even talking about fluidity, but I'm just going to bring something else up. I'm talking about size of units. So a lot of the time I get people come to me going, oh, Alex, I can't buy a unit under 500 square feet. A bank won't give me a mortgage. Wrong. You have to know which banks are going to provide different mortgages. So I can tell you RBC has no size restriction on condo units. So you can get a mortgage from RBC if you have a unit under 500 square feet. TD they're set at 400 square feet. Scotia is currently at 450, but they do make some exceptions. So it's understanding what banks do and what size of units they're able to do. So just wanted to jump in on that, but understanding what banks will do different sizes of the unit. So first of all, you go to your banks. Some banks have restrictions on the number of doors they will finance you for. So what a door is considered a unit. But if you had a multiplex that had 12 units in the one building, that would be considered 12 doors. So they refer to it as doors. So each condo for you would be one door. If the bank has a limit of 5 doors, then they won't provide you any more mortgages with that limit on 5 doors. Now, other banks may go, okay, if you have 5 doors here, I'm okay with that, but I'm only going to give you 5 doors. So that means this bank will go and they'll allow you to start building up a larger number of doors. Or maybe those banks, they're going to be like, no, we're not going to do that. There are then alternative lending companies that will provide mortgage. So for example, Equitable Bank will provide mortgages beyond that initial 5-door limit that some of the big banks provide. So if, let's say, you're tapped out at 5, you probably have a strong cash flowing portfolio. You could then move over to Equitable Bank and they'll start providing you mortgages 6, 7, 8, and 9 for your properties. It will be a higher interest rate. They do price that in, but you're able to get mortgages on those properties. In your first 5, that excess cash flow is going to help fund maybe some negative cash flow that's coming on those excess properties. Remember, we're running a cash flow neutral portfolio. So if some of the financing gets more expensive as your portfolio grows, that's okay, because the funding from the cash flow from the first properties is helping you fund those other ones. Beyond that, you have Home Trust. That is another one that provides some not secondary financing, some B-lending financing out there. It's more expensive, but allows you to continue to grow your portfolio and keep that appreciation game going. Because what we're doing is working our way around the monopoly board, building our houses around the monopoly board. Just because it gets a little difficult at 5 doesn't mean you have to stop, and doesn't mean the profitability of that stops as well. On top of that, you could also do a blanket mortgage. What a blanket mortgage is that a bank would look at it going, okay, we're going to go over your whole portfolio. So they're not looking at doors anymore. They're going to look at the value of the whole portfolio and then give you a set lending amount based on that. So they're going to give you an amount and lend to you on the equity of the total portfolio. They may not give you an 80% loan to value on the whole portfolio, but they'll allow you to expand your number of doors. It's going to hurt your return on investment a little bit because you can't pull all the equity out of it. But again, we have more assets that we have that are going up in value. Now, Kyle, am I going too fast? Am I getting too complicated? This is more of an intermediate class than our basic investing class. But again, more than happy to sit down with anyone and go over these and explain these in more in detail wise. Kyle, you've probably never even heard about the blanket mortgage option either.
No, it's definitely more advanced financing.
Yeah,
feature.
And even on top of that, if you're getting into a larger portfolio, you're able then to switch it from a residential portfolio to a commercial portfolio because of the number of doors, and then do a blanket commercial mortgage on that. So if you're doing a blanket commercial mortgage, again, a lower loan to value rate, but the commercial mortgage, they're lending on the value of the properties versus your criteria. So that's going to remove the stress test qualifications on that situation. Again, a bit of a higher interest rate you're going to be paying on that, but you're going to be able to have a commercial mortgage out there and still have a number of assets available to you. So again, if you have a strong cash flowing portfolio and you're running into a number of units, they will do a whole blanket mortgage on that on a commercial side, commercial lending side. So different ways you can do to manage your portfolio. So then let's talk about a little more fluidity. Okay, so if we bought a condo in 2012, just using my personal example, and my portfolio goes all the way to 2024, that's out of everything that I own, that's my final completion right now. That 2012 to 2024, that's a 12-year spread. So what that means is maybe I'm starting to get a depreciating rate of return on that one that I bought in 2012 and the age of that unit, maybe it's time that I want to sell that unit. It is okay to sell, even though I may be contradicting myself and I say never sell. There is a time to sell when you start getting that depreciating rate of return on the property. Maybe it's getting closer to when it's needing a reno. Maybe the building is running higher maintenance fees on it and is becoming a more of a end user building versus a desirable rental building. So you can always sell your original investment assets, dispose of those, and then you still have your higher appreciating newer properties over here. So we dispose of our depreciating return properties, and then we continue our portfolio wise to our newer, higher appreciating properties. So that's where you have fluidity in the market in regards to moving things around. You also have, if you get into private money, if you want to do some short-term closing options, which we discussed on don't sell on assignment, you can do private money. So you go into the private money market if you're getting into a tight crunch. So what a tight crunch might be, you have planned it out, everything perfectly in your portfolio, closing 2022, 2023, 2024. Well, delays just put everything in 2024. And totally beyond your control. So you just play in some private money. You get into your private money. You may have to close one of your units in private money. Your other units cover off on that loss wise. Maybe you refinance that the next year into an A lender bank, or you can always look at disposing that unit in 1 year because you know that you're going to make a 10 to 20% return over that 1 year time versus selling it on assignment. Kyle, any more questions on fluidity?
I think you've done a great job covering it.
Yeah, so you want to know that your portfolio is always going to be fluid and you're always going to be looking at it every year. Just like you look at your financial returns, you're always going to be looking at the performance of your portfolio. I'll give another case when fluidity was. So let's go back to 2012. And Kyle and I have talked about this before. We own the same building. Our 2012 units are stuck in rent control. And we both have our original tenant in our unit. If we're looking at that and our tenants are still in our unit a few years down the road, we may go, okay, we're going to sell off this asset because we don't have the ability anymore we don't have the ability to increase the rent. The return on it isn't looking that great. Let's dispose of this asset, put this in a newer asset that doesn't have rent control anymore, and focus our investments on these assets. That's another example of fluidity when we're examining our portfolio because we're looking at the whole picture and going, what are our rents on these properties? Where are rents going on these properties? Could our money in these properties be in something else that is getting a higher rent, therefore giving us a better return on our investment? Dispose of that. Let's move our money into there. Again, fluidity of the market. You never sell, but yes, you do sell, but you're never looking to sell. You're analyzing your portfolio, and under an analysis wise, if it makes sense to sell, then that's when we look at dispersing of that asset and reinvesting that in another asset. We're always looking at our portfolio and running our portfolio like it is a stock investment portfolio where we have dividends, where we have bonds, where we have, what do you call them? What you're in? ETFs. I just didn't want to say electric fund transfer, that EFT. ETFs, you have your ETFs. I'm heavily invested in real estate just by the nature. Kyle has a mixture of both. You're always looking at your portfolio wise. So if on the finance side, so you should be doing the exact same thing on the real estate side. Treat this like an investment portfolio because that is what it is. And if you're managing your investment portfolio, you can maximize the returns of it by analyzing it and looking at it every year. And guess what? The difference between that financial investment portfolio and your real estate investment portfolio is this one isn't rocket science. This one is extremely complicated. This one you have much, much more control over. So focus in or I shouldn't say focus in, review your investment portfolio. And if you treat it like a financial portfolio, which you pay financial advisors to advise, if you treat it like a financial portfolio, just think of the exponential returns that you can create by managing your real estate investment portfolio properly. And we're not talking about houses, they're condos, concrete box in the sky. They're so easy to deal with. And if you need advice, book an appointment with us. We'll examine your portfolio with you. We'll go over numbers with you, and we can see if we can find some missed opportunity to bring your portfolio to that cash flow neutral level and look at maximizing your returns and taxable benefits on that. Is that a good way to end it, Kyle?
I think so.
Okay, guys. We'll do our investment portfolios. I hope you enjoyed the intermediate class. We're not going to get into the advanced class next week. There is an advanced class, believe it or not. But we'll talk about that another time. For everyone at alexjwilson.com, making your real estate dreams come true, and Wealth Builders helping you build generational wealth. Okay, talk soon, guys.
Bye, guys.
Bye-bye.